Awesome. Good evening, Chris. How have
I'm doing Ben today.
been busy, but at least not as busy as the weekdays. Got a little bit of breathing room, but still had a few meetings, which is great. Working on some minute setup for the upcoming tax season. How about yourself?
Pretty much doing the same. We're about ready to go and everything lined up. Looking forward to saving some people some money.
Absolutely awesome. As a matter of fact, that's exactly what we are talking about today, is what you should be bringing up to your tax professional for the maximum amount of deductions. And for the folks who's first time in this channel, I welcome you. This is Tosif, and with my very good friend Chris Peden. He's a CPA, EA upcoming, so it's still on the process, but soon to be, hopefully. We come up every Saturday evening to discuss some of the ways that we can actually save you money. We have set a $10 million goal this year. Let's see how much we come up with after the tax season. But if you have any questions, feel free to always reach out and make sure to subscribe so that we can keep in touch for our new and future contents. But coming right back to the topic, Chris, I know this is pretty much the season that, hey, a lot of people ask the question, what do you need from me so that you can have the best tax deduction? What do you typically say to them?
Well, what I do, Tusif, is I give them a list. And you know what? That's something that people get a little nervous about, even if they're not concerned about saving money on their taxes. They're just, a lot of people are afraid that they're going to miss something. And what you and I send people is something called an organizer or just a list of documents that we're going to need from you that would help us prepare your return. And so this just is a list of pretty much of everything. And what I say to my clients is, look, we understand now, he's put an example up here. That's great. We understand that this is kind of nerve wracking, and if some of these things you may not understand about, what it is. So please get back in touch with us because Joseph and I and the people that we work with, I work with my wife as well. We talk about this stuff every day. So this is second nature for us. But please, if something is confusing to you, ask us, and we're happy to answer and tell you what it is because we'd rather answer the question now than you getting a letter from the IRS, which is a lot more involved. So
Absolutely.
you're providing an organizer here, TUSIF has put on there that we would send out.
Awesome. And folks, since we are the fiduciary typically, or whoever is preparing your taxes, they are the fiduciary. So by state law, you are protected with the data privacy law. Even IRS ensures the data privacy. So if you see that, hey, the filer name, social security, driver's license, why are you asking these stuff? Hey, these are the things that we're going to be filing your taxes with.
Yeah, and exactly, TUSIF. And I actually have been getting a lot of questions about why do you need my driver's license for this? Well, TUSIF and I are here in the state of Virginia, and they're actually requiring that in order to file a tax return because they're trying to cut down on identity theft. So that's
Absolutely.
why we need your driver's license.
Yep. And typically, most of these are, if you're a repeating client, most of these are not going to be relevant for you because we already have this information, unless you change your driver's license number. Most of the
Yes.
cases, your birth date is not going to change. Your social security number is not going to change. So for after this is typically the case for the first year, and especially if you have multiple businesses, we typically also need business information. And in most cases, if like a lot of people, what they do is just open up an LLC. In those cases, either we're going to be filing 1065 if you have a partnership, multi-member LLC, and for single members, you're just going to be treated in terms of tax purposes as sole prop. So in most cases, you are going to have a business information. We will need that as well, but eventually those are going to flow through to your personal tax returns. But I have an interesting question, Chris, is what happens is if the partners are just husband and wife, do they have to also file 1065?
Well, if the partners are members of the same business, they're partners in the same business, there's only going to be one 1065 filed. And that's for the partnership. They will each get individual, what's called a K1, which is going to be the information from the partnership return that needs to be put onto your personal return.
Okay, so what happens, because so say for example, a married couple, they're going to be filing a single 1040 form as well, because
Yes.
if they're married filing jointly. In that case, if they are the only owners of a partnership, like an LLC, do they have to file a partnership agreement, or they can just file as a qualified joint venture?
I always recommend a partnership
Okay.
and qualified joint ventures. That's something that, you know what, that would be something you want to sit down with a lawyer and discuss, and not punk accountants like Tusif and I. Run that by, and my high school business teacher, Ms. Cohn, God rest her soul. She was ancient when I was in high school 40 years ago. But she always said, always get a partnership agreement. And we joked with her and said, well, what about if you went to business with your husband? She said, yes, even if I went to business with my husband, I would get a partnership agreement. So this is one of those things, you're sitting down going, I want to do a joint venture versus a partnership. You both sit down with that lawyer and see what the best option is. Sit down with Tusif and I and say, all right, this is going to be the best option for you. Let's walk through this.
Awesome. That's one of the things that, of course, the reason I brought it up is even if you do qualify as a qualified joint venture, of course, you're going to be filing two separate self-employment tax returns, self-employment forms. But at the end of the day, even though the total amount of taxes might just be the same, sometimes it's better to file a 1065 because it helps out, especially with the lenders. Because on lenders' terms, you guys can get divorced.
Mm-hmm.
But when it comes down to who's going to be responsible, if you're just like that, a lot of the lenders would not want to lend because they cannot get the money on the fiduciary side.
Yep.
Awesome. And on this case, another question I had is, what if husband and wife are staying at different place and they have two different states? This typically happens for the military spouses. What happens in that case?
Well, they can still be considered married. The federal government knows that we do have service members who are going to be in separate places, but that doesn't mean that they can't file jointly.
Awesome. So that's another thing I wanted to clarify because I do have a few um, members who are actively serving in the different sectors of the military or even different services. While we do appreciate your services, another thing that we need to be cognizant of in terms of taxes, if you're actively maintaining the two addresses, the separate address than your spouse, make sure to include both of their states separately. Otherwise, this form is most likely going to be the states are going to be pretty similar.
Yes, indeed.
Another question I had in the occupation, what if someone has multiple jobs?
Well, most of the time, people are going to be doing the same type of work. Like Tusif and I are both going to be accountants and doctors at the same time. So with occupation, you really want to try, and it's not necessarily your job title, it's going to be what you do. Like some people say that I'm a real estate goddess. Okay, in there you'd put realtor. You're not going to put real estate goddess, um, although you probably are. But you want to give a description of what it is that you do for a living, even though you may have more than one job. And if it's, I know I've had clients that have a job that they work for the federal government, but they're also working security for we have a local concert venue here. And you're doing that part time. You really don't need to just say, all right, well, I do this, but I also do this. What really is what your main thing that you're doing? Because
As
we're
a
all going
matter
to
of
have
fact,
side hustles.
As a matter of fact, I might be someone who's kind of in a sticky situation like that because I'm a tax professional as well as a mechanical engineer.
Okay, but you're a multiple business owner, so we could say entrepreneur.
Oh, that's awesome. And of course, same thing goes with the service members. Typically, they are also in the military, and they actually also, say, for example, doctors, engineers, and also have businesses as well. So make sure to include those in this same thing. So typically, we send out these organizers, and we typically help people out in different ways. The next thing is, of course, the addresses that you're maintaining. Uh, Typically, even though there's two different states here, typically if you're married, filing jointly, you will have a single address. You can maintain multiple addresses. One of the things that I have come across is if you are dealing in multiple states, it might be better to consolidate in a single state as resident state and have the credit from other states. Chris, what have your experience been?
Well, I haven't run across people who have residences in multiple states. Most of the time, most of people try to stay close to home with it. But if say you have a rental property in another state, you want to make sure that you do fill out a tax form for that particular state because you are earning income in that state.
So, say for example, someone lives like very common example in this area is someone works in NIH, say for example, but lives in Virginia, which NIH is in Maryland, Virginia is in the DC, Virginia is on the other side. So even though he's making money in Maryland, but he's actually a resident in Virginia, how does that work out?
Well, they do have reciprocal agreements, and what they're going to do is say, all right, well, you live in Virginia. We're going to have taxes withheld from the state of Virginia because that's where you are. And sometimes what will happen is that payroll companies or payroll departments don't always put in the right state for you. Like, well, you're working here, so we're going to withhold money from the state of Maryland, for the state of Maryland. Then when you're doing your Virginia taxes, you haven't had any Virginia taxes withheld. Well, the great thing is that Virginia has a credit for taxes paid to another state. So while you would fill out a Maryland return, you'd also fill out the Virginia return and then also get credit for the taxes that you're paying in Maryland. So a lot of states, especially states when you're bordering on other ones, will have these type of agreements, and you should be able to get a credit for the taxes that you're paying in the other state. But
So
make sure that you talk to your HR people, look at your W-2 and your paycheck, make sure they're pulling it for the right state.
awesome. So for the people who are getting a W-2, they should be on a broad scale, they should be looking at when they're getting the W-2, should be looking at the withholding in their resident state, not necessarily where they're working.
Exactly.
Okay. So what happens if, say, for example, someone is working on the state of Maryland, but lives in the state of Delaware, where Maryland needs to withhold taxes, but Delaware does not have a state tax? What happens then?
Well, you may be able to, because Delaware is your state, they would just not pull out any taxes, or they should not pull out any taxes. Maryland may want to, but I'm sorry, Maryland, but they're not a resident of your state. And I lived in Maryland for a while, so nothing against Maryland.
Yeah, I mean, when I first came to US, I was in Maryland as well, especially in the College Park area. Great place, of course, but I feel like the more south I go, it's better for me because of the weather. Uh,
Yes, well, we love Maryland in our town, so fear the turtle. So,
Absolutely. So the next stage is definitely look into this is the marital status. And unless you have any specific reason for the people who are married, try to file married filing jointly because
mhm.
otherwise you're going to lose out on credits, limits, deductions, and all sorts of stuff. And this specific area is significantly important for us because this legally separated is different than single in some cases and different than married as well in some cases. So that's where it becomes interesting and somewhat we as tax preparers need to do our due diligence, specifically if we are going to be in a separated divorce situation and we need to file it as a head of household. So that becomes a requirement of tax preparer due diligence checklist by IRS that we have to go through, take you through, ask some more additional questions. And again, another thing is if you have lost your husband or wife, uh, if you have not got married by the end of the year, we are still going to be qualifying you as married filing jointly. And the next 2 to 3, is it 2 years or 3 years, Chris? I don't remember, but somewhere on that as surviving spouse.
Well, actually, it would be a qualifying widower, but that's only if they have a dependent. So it would switch over to single if they did not have any dependents that they can report on their tax return.
Awesome. And they need to not get married to someone else again.
Well, we'll let them make that decision, and we'll sort it out when we get your tax stuff. As long as you come back to us and your spouse agrees to do your taxes with this Chris or Tusif, everything will be okay.
I appreciate that. Yeah, so it's not a matter of don't get married thing. Definitely get married, but of course, it's just a matter of you need to let us know the updated marital situation for us to actually capture them properly. Awesome. Now this is where I guess it becomes more for single business owners and also the W-2 refunds withheld. Walk us through here, Chris.
Well, okay, so we have estimated taxes paid if you're a business owner or you are a heavy income earner, then this might apply to you for the estimated taxes you're paying. But for Section 8.5 there is going to be if you want your refund direct deposited, which you'll get it a lot faster than waiting on a check for the IRS. This is a section you can fill out to let us know this is where I want my refund going. And it's either checking savings or do an allocation there. So this is an important bit of information if you're getting a refund.
Absolutely.
But
So
also, just if I
definitely,
could throw in that if you want us to make the direct deposit or direct payment from your account, we would need this information as well.
absolutely. Awesome. So, and of course, if I remember correct, if you go to IRS website, if my memory does not cheat me, IRS takes about at least three to 7 weeks, I think, to ship a check, as opposed to I think it's within less than between 10 to 21 days for direct deposit. So definitely, it's a significantly faster process. And if you are thinking of getting a refund, or even if you have to pay taxes, instead of writing a check, a lot of people forget the IRS can just pull the money from this specific bank account. This is significantly faster for all of us. Awesome. Now, of course, the next section goes down to the income, how much you're making, tax refund, those kind of stuff. And 1099G is typically for the gambling. If you had something like that, definitely let us know. And especially if you have been into some of those aspects, they are typically also going to issue some these kind of statements to you. We definitely need those as well. In terms of retirement plans, that's a very important thing. A lot of people miss out. Walk us through this section, Chris.
Okay, so a couple questions that we ask here is a retirement plan with your employer. So that's actually going to affect what you can deduct if you have a traditional IRA or a Roth. Now, and also asking, did your wife or excuse me, spouse convert? Did you or your spouse convert traditional IRA to a Roth IRA? We're going to need to know that as well because there is some tax implications with that. And just as a side note here, folks, if you're thinking about making some change with your money, major changes like this, run it past Tusif or I. Just let us know, hey, this is what we're thinking about, so we can make sure that you're not getting hit with too much tax. So usually, June, July, you're sitting here, or maybe beginning of September, you want to just chat. Yeah, just give us a buzz and say, hey, we kind of want to chat with this. I talk to my clients all the time about this. they want to make sure that they're not paying taxes. So
Absolutely.
yeah, and so we have kind of traditional IRAs, KEO and SEP plans, Roth IRA, uh, coronavirus distributions. If you had some of those and they got recontributed in the last tax year, let us know about that. So this is just so that we can keep up with everything that's happening and can advise you on this is what you need to do.
Absolutely. And interestingly, recently, one of my friends who's also a real estate investor, one of the mistakes they did is when they changed their job, what they ended up doing is instead of rolling over to another qualified plan, they actually took the money to buy another property.
Uh-huh.
Now they have to not only pay taxes on the entire thing, unfortunately, they're recognizing an additional 10% penalty. So
That's
this
why you
is
need to have a
why,
conversation with us before you do these things.
yeah, I told them that, hey, you could have just rolled over, not recognized any taxes or penalties, and took a loan against it since it was a 401k. And still could have bought the property, and from the property you could have just refi it out, pay it back. That was it. But that actually may push them significantly higher tax bracket, and they were not able to take the full depreciation against their regular rental income as well. Because if you're making more than 150, you're not actually able to take more than $3,000 in passive losses.
Yep.
Awesome. So this is one of the interesting parts as well, especially with educational accounts, HSA. These are really important for most of the W-2 people. Is if you are helping people, like even 529 plan, qualified educational for your dependents, make sure to include those. And say, for example, HSA, those are actually pre-tax contributions and tax preferred accounts. So if you are a W-2 employee and you have a matching scenario, if you have been leveraging that, make sure to let us know. And especially these areas where you may be able to qualify for a deduction or in some cases credits as well. Anything else you want to add here, Chris?
No, I think you covered everything there, too.
Awesome. So definitely, especially a couple of the things I wanted to really focus on with inheritance, if someone died, and also if you had foreign transactions. I know FinCEN is working out. A lot of people are pulling up the aspect of Corporate Transparency Act. If you have not checked our previous video, go make sure to check it out. Check us out. And especially with a lot of things going on the internet, people are buying real estate and gold and silver collectibles. So gold and silver and collectibles are treated differently. Even crypto is treated differently than a regular transaction or regular capital gain sale. So let us know what you have been going through, and we can actually look into those aspects and include those so that you don't get hit with some surprise tax bills. Awesome. Next part is the dependents. Why is it important, Chris?
Well, because you could get quite a bit of money off your taxes for all the dependents that you have. So don't ignore this section here. And even if they're college age, you still can get some money for it. Now, granted, 17 years and older, you're only going to get, say, 500, where for a child under 17 is going to be 2,000 a year. Still, don't sleep on this. And if you think, well, it's only $500, send the $500 to Tusif and I. We'll use it if you don't necessarily want the money, but let's report it.
And as a matter of fact, part of it is actually refundable.
Yep.
That means even if you did not owe any taxes, you had a potential to get back. So of course, it's not the full amount, part of it, but hey, if you're not paying any taxes, IRS is paying you, why not take it?
Absolutely.
And if you have more dependents than this, make sure to add them on attachments, similar fields, and make sure to give it to us as well.
Yes, indeed.
Awesome. So now interest income. Of course, interest, dividends, these are treated separately as a W-2. These are not active income, and you have separate type of tax treatments for those. Like, correct me if I'm wrong, these don't have FICA tax against them.
They do not.
Awesome. So you're actually getting a discount of 15.3% if you have income like this.
Yep.
Similar thing with if you're selling properties. And I know it says investment sales, but also make sure to include if you're selling a personal residence. There is an exclusion of up to 250 if married, and 100. Sorry, if single, and 500,000 if married. So that's called 121 exclusion. Awesome. Now we go to itemized. This is really interesting because if you're taking standard deductions, which is close to 13,000 and some change for single, and double if you're married filing jointly. But in some cases, say for example, if you're living into a high posh area, you have a significant amount of interest in your house, especially the first few years, itemized might be the better option. And these are the things that we can actually itemize in your tax returns, specifically if they are more than 26,000, if married, 13,000, if single. Of course, it's not the exact, somewhere in that ballpark. Fill me in. What did I miss here?
No, well, what you're looking at is going to be medical expenses. What you need to know about medical expenses is that you only are able to deduct the amounts that is greater than 7.5% of your income. So if you made $100,000 this year, and you spent 10,000 on medical, which is quite a bit, you will be able to take a deduction of $2,500 because that's 7.5% of 100,000 is 7,500. You spent 10,000, so you get to take the difference of $2,500.
It also applies if you have spent that for your dependents as well.
Yes, it does.
Like if you have children, minor children, you had to spend some money on that, your insurance didn't cover, those kind of things we can also include. Of course, as long as it's more than 7.5% of your AGI. In some cases, if I remember correct, it's also 10%. So depending on your age and also the amount that you're making, we can probably look into that as well.
Yep.
Same thing again, on the itemized side, if you actually had to get any investment interest and also interest paid, and also some part of taxes paid. I know since 2017, I believe it's capped at $10,000.
It is
on the taxes, but
is.
hey, even if it is 10,000, if you're paying more than that, even if we did take the maximum amount, why leave it?
Exactly.
Awesome. As I mentioned, if you have a high interest rate area, especially the interest rate being pretty high now, and in the beginning, having multiples of in many cases, at the beginning years, it's higher than the principal itself. So if you're paying a good chunk of money for your mortgage, that might be a part that we can actually write off. And if it is itemizing and coming more than that, it is an itemizable write-off as well. And as a matter of fact, if you did take home equity loan, that's also part of it. Awesome.
Yes, indeed.
And of course, in both cases, you are going to be getting some forms from those mortgage providers. That's also going to be a tax forms that we would also like to see as well. Now, charitable contribution. This is great for me. because on top of all of these, if you also made charity to qualified 501(c)(3)s and other qualified organizations, we can definitely use them for write-offs as well. So make sure to fill those in. And of course, depending on what type of contributions you made, if it is cash, it has a higher limit. If it is non-cash, depending on what type of institution that is, definitely we would have to take it at different ways with the fair market values and stuff. Awesome. Now, how does the investment expense work? Help us understand, Chris.
Okay, so just for years, 2018 to 2025, they're not going to be deductible. That was the result of the 2017 Act that was put in place. So this isn't something that but as it says in here, they're allowed in some states. So do a check with your CPA to see if it's allowed in some states. In Virginia, it's not. So this is one of those that we're going to pass by, but please put this in here, fill it out just to get into the habit of doing it, because we'll see what the law changes come 2025, because I imagine there's going to be some big debate about how whether or not these should continue going forward.
Absolutely. And one of the things I liked about Virginia governor, he is pushing for some tax breaks. So I hope he also keeps it up, and we'll look into that as well. But if you are into some other states, maybe non-Virginia, this might be applicable for you as well. So make sure to look into those aspects, and we can definitely look into that as well. Casualty loss. How does that work out with the current scenarios?
Well, the current scenario is that you actually have to be in an area that has been a presidentially declared disaster area. So now, while you may have something that, we had a windstorm and knocked something down and you had a casualty loss because of it, unless the president comes and says, yep, I declare that a disaster, you're not going to be able to claim that. But there was loss from theft or embezzlement, as well as a result of a Ponzi scheme, that you're going to be able to take a write-off on.
Yes, this, as a matter of fact, one of our clients from Florida, she actually had this kind of elements. She had, I think, close to $90,000 or $100,000 in Ponzi scheme that was federally declared as Ponzi scheme, and the federal FBI agents are actually resolving that. So can they take the entire money in the same year?
Well, it's going to be a limit that exceeds, as it says there, generally after insurance reimbursement must exceed 10% of your adjusted gross income, and then only the amount that exceeds the 10% in deductible. So you're going to be limited with the amount that you can take.
Okay, but I mean, the amount you couldn't take, does it carry forward?
No, it will carry forward. So
awesome. So if you already lost something, make sure to include those. I know I have a friend who lost, I think, 37,000-ish. So as long as it's meeting that certain limit, we can actually keep taking those up until we actually recoup the entire expense. Miscellaneous, of course, definitely look into that, depending on what you're using it for. But this does have a 2% AGI limit up until 2025. But hey, even if it is 2%, why not take it as well? Now we go to the business expenses. Now it becomes, I guess, it's easy and also a little difficult, because as long as something can be ordinary and necessary, it's deductible or even depreciable.
Yep.
But if it is not ordinary or necessary, excuse me, it is not deductible. So you can, as Chris has favored examples with alpaca, is just because alpaca can be a deductible thing for one business, that might not be the same thing for another business. So make sure to understand what your type of business is, and we'll take it accordingly. And as long as you think that something is ordinary and necessary, make sure to include that.
Yes, indeed.
Awesome. And one thing I wanted to speak about the business miles is Vehicle expenses, we're limited to choosing either or. Either we take the mileage or we take the actual expense, unless you are afraid, which means you have more than 4 cars, 5 and above. You're operating at the same time for your business purposes. In that case, we have to take the actual expense as opposed to the business mileage. So if any of you guys maybe have a trucking business or subleasing to Uber and those kind of people, or rental or car rentals, make sure to keep all of your expenses, as long as they're, doesn't matter what, as long as they're ordinary and necessary, we're going to be able to write them off. And in some cases, we might even be able to leverage Section 179 and bonus for the same year. Interesting thing, away from home expense. Why is it different, Chris?
Well, because you're going to be traveling for business, and what you're going to have there is that you would not incur these expenses if you were living at home. So you can see there the airfare, the auto, the meals, which are now going to be at 50%. And the reason that's 50% is that if you're home, you're going to eat anyway. So we're not going to give you too much of a break just because you're on the road. But just the cost of some other items there, because you're out there traveling as part of your business to make money. So the IRS is trying to encourage people to start businesses and to get out there and spend money for being away from home.
An interesting thing here when talking about meals is this meals deduction is specific for restaurants. If you grab a lunchbox from Walmart, it's not going to be deductible. It's going to be considered as grocery.
Yes, it is.
So make sure whenever you're going out, I mean, it's easier. I know you might like, hey, I want to use a ramen. Awesome. But hey, unfortunately, that might not be deductible all the time.
Yes, indeed.
Home office expense, that's a very important thing. Walk us through a little bit about this one, Chris.
Yeah, this is a great one, because if you have a room set up that is just purely used for your office, or even a part of a room used for an office. I remember hearing a Supreme Court case about someone living in New York who had a home office in a hallway of a New York apartment. Well, everyone knows how small New York apartments are. So Supreme Court said, yeah, that counts, because you're just using it for an office. Yeah, you'd be walking through, it's all right. But I do a lot of work at my dining room table. I can't write that off because we eat there. So that's something that you would not be able to do. But if it's something that you set aside, whether in your house or you set up and get a she shed or just another structure, you can use that as well. But just make sure that that's something that is specifically set aside for your business. And we can see everything you have in here. So please keep track of these items. This is going to be something Yusuf and I would be asking for.
Awesome. What happens if you have a restroom next to your office space as well, which you typically use when you're having on your office hours?
I would probably shy away from putting that in there. It's all the expression is going there to do your business. I'd kind of stay away from that. Just when you're sitting in your office doing business, what have you. But if it's part of a suite that you put together as part of an office, I think you may be able to include that. And if you have customers who regularly come in and they have to use the restroom, then yeah, that's something you certainly could consider.
That's a great option, because like on my place, if there is more of the customers that does come in, some of the customers are more of family friends, especially on my line of business. They do typically use it. That's why that's a different case for me. But if it is just exclusive, as Chris was mentioning, make sure to understand what the ordinary course of action is. Two things I wanted to spotlight here is, excuse me, there's two ways to actually take it, just like vehicle: actual expense and simplified expense, which is $5 a square foot, up to $1,400. So you have these two limits. So that means part of your home's depreciation can also be taken.
Yep.
as proportionate to your office space. But if you do take the $5 a square foot, that actually includes a component of your depreciation. Now, if you do sell it, make sure to give those data to your CPA or tax professionals or EAs, because they need to recapture some of those taxes that depreciation was claimed against that office space. So these are a couple of the insights that I wanted to pull out. And of course, education and tuition credit. How does that work out, Chris?
Well, so as you know, it's listed under business expenses, but if I'm taking a look here to see why that is included in there, but maybe this is part of something that is not business expenses. But if you're going back to school yourself or you're paying for your kids, you are allowed to take a deduction for the tuition that you have paid. Or if you are, it says here for job-related continuing education, you would be able to take that. I believe that's a lifetime learning credit that you should be able to take on your return. So that you would get a 1098-P from your the educational institution, and if you're using your 529 plan or an educational savings plan, you get a 1099-Q that gives you the amount of money that was pulled out of that so that you could report it on your tax return as saying, no, this was used to pay for education, so don't tax me on this money.
Awesome. A couple of the things I wanted to also point out, as Chris mentioned, is the lifetime learning credit that Chris mentioned. As long as it helps you to get a job, it is available. Another thing is American Opportunity Credit, if I remember correctly. For that, it has to have related to a degree. But the lifetime does not really require a degree, but that does require a specific trade or a specific reason that is going to have some sort of income production as well. And unfortunately, as it's mentioned here for employees, the continuing education is not available. But say, for example, in case of real estate agents, since they are the sole proprietor, in many cases that can be written off as well, because that is required for keeping their license itself. So that's a different thing, but not just for self-development or like a seminar that you go for to network. Those are not very much deductible up until 2025. But if it is a requirement, as I mentioned in the beginning, is as long as it's ordinary and necessary, let's take a look at those. I know we're pretty much close towards the end. I wanted to, I don't want to have it much long, but a couple of the things I really want to focus on. Rental real estate is really important because if you're leveraging the depreciation, that can be a great source. And the expenses, if you're a sole proprietor, hey, that's everything is flowing through depending on how you're actually structured. It can be either Schedule C, Schedule D, Schedule E. But for partnerships, which is multi-member LLC, the 1065 typically flows through as K1, as Chris mentioned earlier. So make sure to understand those as well. Anything else you want to add here, Chris?
No, just keep track of these expenses as they go on, and it may require a little bit of digging on your part at the year end to get us it. But think about it, every dollar that you could, every $100 that you find is going to save you $20 in taxes. So make sure that you have this information together.
Absolutely. Self-employed, of course, you are taxed pretty high with the self-employment tax, but you also have a significant amount of deductions as well. So make sure to include those, as I was mentioning, with any expenses and related information like EINs and stuff. Make sure to provide us those as well. We are towards the last section of it. Of course, home sale energy credit, which is of course another interesting thing I forgot to tell people is if you're into renewable energies and if you're into a decent area, renewable energy credit can be pretty decent, especially for your personal residence as well. You can write off, in some cases, up to 30% of the installation cost as credit, not a deduction. That means you get a dollar for dollar deduction up to 30% of the expenses that you put down for your renewable energy stuff. And the same thing as I'm mentioning, if you're selling a property, let us know. And especially another thing is if you have part of your primary residence rented out, depending on what the square footage is and how it's structured, we would have to claim that as a capital gains as a regular investment property, as opposed to the 121 exclusion on the full home as well.
Right, and as we were talking about earlier, if you're thinking about these things, bounce it off us, because we can make sure that you're not going to pay too much in taxes for this, and we'll look for ways to save you money so that maybe you don't even need to pay taxes on it.
Absolutely. Same thing with the business deduction, home sale or debt relief. Debt relief is considered as an income, active income. So whenever you are having like student debt relief or whatever debt relief you're having, if you're having it on a personal level, you have to claim it on a personal level. If you have it on a business level, you have to claim it on the business level. So make sure to include those in the income. And of course, if you have any other questions, feel free to reach out. Those are some of the basic things I would say on a broad scale people would need in terms of getting us ready for tax preparation. Chris, anything else you wanted to include?
Well, I do want to emphasize, as you saw on the last page, any questions you may have, no matter how crazy it may seem, please run things past and say, hey, do you need this? And if you work in QuickBooks, there's something, an account that's actually called Ask My Accountant, that you would just dump things in so that the bookkeepers that Tusif and I work with can run through them, or run it past us and say, well, how do you handle this? So something pops up, no matter how weird it may seem, you're not going to shock us anything. I mean, I sometimes say, look, we're like Catholic priests during confession. There's nothing you're going to say in there that's going to shock us, really. It's so just say, hey, this happened, or I got this sheet of paper from the IRS. What does that mean? And I will tell you that as long as I've been in this business, 15 years or so, I still, when I see something from the IRS coming in the mail, I get nervous about it. So we understand you're nervous about it. Even most of the time it's just something saying, oh, this particular number for you has been renewed, so you can do taxes for another year. But still, we understand that this is a nerve-wracking process. Don't hesitate to ask the questions.
And even in some cases, local tax jurisdictions as well. There's a lot of local jurisdiction that might be tax deductible as well.
Yes.
Some of the taxes you're going to be paying, like excise tax, if I remember correct, is also tax deductible. And some of the local jurisdiction taxes are also can be deductible against your business income. So don't shy away from telling us how much you paid just because you feel like, hey, I just had to pay it.
Yep. Run it past us.
Absolutely. And if any last words, Chris, before we wrap up tonight?
Nope. Just have a great rest of your weekend. And as always, Tusif, this was a lot of fun.
Thank you very much. Thank you, everyone. I appreciate your time being here as well, Chris.
Good night.